Welcome to the Man from Macro, where we look at some of the big themes in today's global markets. This week, a slight deterioration in some of the US data is rekindling thoughts of a slowdown and potential recession. Now, this might seem a bit far-fetched considering the recent 4.2% reading on the Atlanta Now GDP forecast, as well as the many false starts we've seen on recession forecasting over the last couple of years. And as David Bianco recently pointed out on the app formerly known as Twitter, economic expansions don't just die of old age. They need a catalyst, such as COVID or the credit implosion of the great financial crisis. Still, the market got excited because the non-farm payrolls was, for once, a bit softer than expected. Bond yields fell, and although it wasn't a massive move, it did halt the march back to the highs of 2023. Now, of course, employment data has been prone to huge distortions over the last few years, but it was a rare miss, and the market jumped on the data print. Analysts, too, have noted the reversal in the unemployment numbers. Currently, the US unemployment rate remains historically low, at 3.9%, but it's the direction of travel that's of note. All US recessions over the last 50 years have been defined by unemployment that is accelerating higher. Once the unemployment rate has decisively turned, it often builds momentum. It's the inflection point that matters and not the absolute level. Once a new trend is established, it rarely looks back, although there can be a considerable lag between the inflection point and the onset of a recession. In fact, a recession only occurs during the acceleration phase. Unfortunately, jobs data is very backward-looking with regular revisions. But we still need to be wary if it starts to build a negative head of steam. Furthermore, we can see that the NFIB Small Business Optimism Index has made a new low. Excluding the inflation shock of 2022, the US has always been in recession with the index at these levels, unless it was in its recovery phase off a low. Perhaps it was just a false start 2 years ago, and this is now the real thing. And why does this matter? Well, during all those recessions with accelerating unemployment, the US equity market made a tradable low, some of which were major bear markets. But the problem in gauging the response to deteriorating data is that initially, expectations will be for looser policy, such as rate cuts, an end to QT, and a resumption of QE. By way of example, the US equity market loved the weaker payrolls print and rallied handsomely towards the all-time highs. Therefore, the initial reaction to softer data could be for risk assets to maintain a bid. So what could be a catalyst for a reversal? We may have to look overseas for a potential source of risk. The Bank of Japan currently has its hands tied because it needs to defend its yields. But if interest rate differentials are reduced because US yields are falling, that could support the Japanese yen, which had tracked the differential between US and Japanese yields for the last few years. Given the recent declines in the yen versus the dollar and the intervention by Japan to defend its currency, a narrowing of the yield differential might be a good thing. But we should be careful what we wish for. The Bank of Japan has also incrementally started to tighten. And whilst these are tiny steps from a major economy, there is past form. When the Fed rate cycle has peaked in the past and then reversed at the same time that the Bank of Japan has been tightening, it's been Japan's tightening cycle, even when it's been a small step change, that has rung the bell on the US recession or the top of the equity market. This occurred into the recessions or bear markets of 1991, 2001, and the Great Financial Crisis. Now, 3 data points are not exactly a data set that we can hang our hat on, but we can also see how the US tightening cycle of 1994 was accompanied by Japanese rate cuts. The US equity market rallied and there was no recession. Rate differentials could define the direction of the yen carry trade. A yen that surprises to the upside could undermine global risk assets. Overall, a stronger yen is not a base case, considering the Japanese economy is caught between a rock and a hard place. But if yields are converging due to weaker US data, then a stronger yen could be a catalyst that's beyond the control of the Federal Reserve's monetary and macro-prudential policy. Now, not many will be playing for a stronger yen, but for some, it's a hedge against a potential exogenous shock to risk assets. That said, please remember, none of this is investment advice. These are just observations for educational purposes only and not trade ideas, and everyone should be aware of their own investment objectives and risk profiles. But thank you for watching.